Hello, and welcome to the latest instalment of MFS's Conversations with Connor, where we break down the key property news stories and what they may mean for you. Before we dive into today's episode, I want to take a moment to share a quick disclaimer. MFS are a bridging loan and buy-to-let mortgage provider and are not financial advisors. The opinions and views expressed in this episode are personal to the host and guests and may not reflect the views of MFS. For more information on MFS, you can find us at www.mfsuk.com. Now, let's get started. The new tax year, as of recording this, is just around the corner. And for property investors, that means a few key things are changing. Stamp duty costs, furnished holiday let rules, council tax rates, and so much more will be upended over the coming weeks. If you're worried about what's on the way, it's essential that you seek guidance from a tax professional or a financial advisor on what's best for your portfolio. In the market, though, we're already seeing evidence of adaptation among homeowners. Halifax reported that average house prices remained steady in February, with the stamp duty changes likely fueling that market activity. In fact, over 500,000 UK home buyers are working to finalise purchases before stamp duty thresholds change in April, according to Rightmove. This has been the trend in the housing market for a surprisingly long time now. Despite everything, last year proved to be action-packed for buyers and lenders. Savills found that the UK housing market expanded by 6.3% to about 379 billion in 2024, which was driven by a 22 billion increase in spending on house purchase specifically. Correspondingly, UK Finance revealed home loans rose by almost 16% last year. Amazingly, housing affordability itself returned to pre-pandemic levels at the same time, with the ONS detailing that in England, the median house price was 7.7 times the median annual earnings of full-time employees, a significant increase from the ratio of 8.4 seen in the year before, in 2023. The residential market essentially is stabilising. Looking ahead, this stabilisation could soon turn into growth and opportunity. Specifically, demand for larger homes is on the rise, with terraced houses seeing annual growth of about 4.5% and detached properties seeing an increase of 4.1%. A few notable developments are in the works, which will also highlight a few potential investment hotspots. Trafford could be one of 2025's top investment locations, with a 1.6 billion regeneration project, Trafford Waters, underway. Also, reportedly, the arrival of HS2 in West London is creating a new investment hotspot worth roughly 10 billion to the local economy. A study commissioned by HS2 Limited shows that the construction of Old Oak Common Station is driving a regeneration in the area, which could lead to thousands of new jobs and homes over a 10-year period. And just as a reminder, when Crossrail finally emerged, house prices along the line jumped. There have also been some mixed results in the buy-to-let market in March. Zoopla released its latest rental market report, which showed annual rental inflation for new lets in the UK is up 3%. It's rising, but Zoopla pointed out that the annual rent inflation for new lets is running at the lowest level for 3.5 years. But at the same time, a report from Sykes Holiday Cottages found that holiday let owners specifically earned around 24,600 in income in 2024, up from 2023's figures. And specifically, the Cotswolds had the best results, where owners are did generate around 29,000. Also, separate research from RICS revealed that a shrinking pool of rental properties continued to drive up rents in February, and many letting agents expect rental prices to rise over the next 3 months. Fortunately, it looks like many property investors are turning to the specialist market to take advantage of these kinds of opportunities. A recent survey revealed that more than 6 in 10 UK mortgage brokers rely on specialist lenders to secure financing for their complex cases. The major banks are losing ground to their specialist counterparts. Legislation-wise, there were some substantial developments this month. Matthew Pennycook, The housing minister vowed to end the leasehold system in England and Wales before the end of this parliament, which will affect around 5 million homes in England alone. This plan has been brought up many times in the past by various governments, but Labour has that sizable majority behind them, so they might just get it done. The Renters' Rights Bill is also one step closer to reality. It was confirmed that the committee stage of the bill will start on the 22nd of April. Here, peers will scrutinise the detail of the bill and debate and agree any proposed amendments. There are only 3 more reviews until it officially makes royal assent, and we'll all need to adapt. It's been a big few weeks for the government and the wider economy, of course. With the new tax year looming, all eyes were focused on the latest inflation figures and the Bank of England's base rate decision. There's been a mixed bag of results here. The Monetary Policy Committee chose to keep the base rate unchanged at its recent vote, but at least it wasn't raised. And also in positive news, inflation fell to 2.8% in February. But, of course, the main focus for many of us was likely the spring statement. In the end, there wasn't much announced that will dramatically affect the property market. But there were a few key highlights that many property investors and landlords will want to pay attention to. A few key highlights. One includes the announcement of changes to the planning framework, which should help build over 1.3 million homes in the UK over the next 5 years. And Rachel Reeves actually said this puts them in touching distance of their promised 1.5 million homes. The Chancellor also announced that inflation should fall back to our 2% target by 2027. There are also going to be apprenticeships for 60,000 new construction workers, which of course should hopefully help with getting all those houses built. And also there is the creation of a 3.25 billion transformation fund to fuel reforms to public services and make the government, and I quote, leaner and more efficient. Hopefully this should reduce costs in the government and it will hopefully speed up all those delays that everybody's struggling with, including in the courts. Also, importantly, universal credit, the standard allowance will increase from £92 a week to £106 per week by 2029/2030. This is important to note for anyone who may be renting to benefit claimants. And then outside of that, there were other announcements and other breakdowns of how our economy should hopefully do over the next few years. So hopefully from the welfare reforms announced, we should save 3.4 billion. And the government's going after tax fraudsters, putting more oomph behind that. So, make sure you're up to date with HMRC. We'll have to wait and see how the market reacts to all this and obviously see how much of it actually comes to fruition. But like always, in the meantime, if you need any support via specialist lending, make sure you reach out to Market Financial Solutions and we will see if we can find a solution for your specific investment needs. I'll check in with you in the new tax year. Good luck with everything and thank you. If you enjoyed this episode, don't forget to subscribe, like and share. You can access our previous episodes in all the usual places as well as on our website at www.mfsuk.com/podcast. See you next time.